Hi, and welcome to another edition of Expertalk. I'm your host, Glenn Berkins, editor and publisher of QCity Metro. We are fortunate today to have with us David.havlik. He's a mortgage banker with SouthState Bank. David has been a mortgage banker since 2006, I believe.
Right.
He's been with SouthState Bank since 2014. And in each of those years since joining SouthState, he's put up some very impressive numbers. In his first full year in 2015, he closed $23 million in mortgage loans. And it has increased each year. This past year, David closed more than $53 million in mortgage loans, which earned him the distinction of being named Diamond Elite status, or getting the status of Diamond Elite. David is here today to talk with us about the importance of credit, especially in the area of home buying. We all know that how important a good credit score is, or having good credit. And that's what we're going to talk about today. We're going to explore various aspects of the importance of credit, especially for people who are looking to buy homes. So let's just jump right in there, David. Why is credit so important?
Great question. So credit is really a tool of your financial life, right? It gives you the power to leverage, I wouldn't say beyond your means, but leverage to accomplish things in your life financially that are needed, right? Cars, homes, things of that nature. And it's very important to work on that credit. It is a tool for your financial life to help you be successful. And it is something that, we should talk about more in our society, in our schools, and it's a very important part of being a successful financial person and having a successful financial life.
So we hear people talk about having good credit. What is good credit, and why is that important?
So credit is all relative. It's on a relative scale, right? Having good credit is important because it allows you to obtain the best products, or the widest array of products, whether it be for buying a home or a car. In this case, of course, we're talking about home purchasing, but there are multiple products on the market for loans. And the higher your credit score, the more access to those products and better interest rates you'll have. That then, of course, translates into more cash flow on a monthly basis, because you'll be able to have lower interest rates, or maybe access to a better product that may allow you to then accomplish something else in your financial life.
Most of us have some idea of what our credit score is through something called a credit report. Can you talk about that for just a minute? What is a credit report?
Yeah, so your credit report is the summation of your financial history as it relates to your pay history on various types of accounts you may have, revolving credit cards, home equity lines, your mortgage, student loans, any other kind of personal loans you may have. That will disclose to the bank, or even you as the consumer, what those terms are of your credit, of those individual accounts, what your pay history is, what the credit limit might be if it is a revolving credit account, and what your usage has been. One of the new things that the credit bureaus have implemented over the last couple of years is disclosing almost on a month-by-month basis what your usage has been. So myself as a banker, I can go in and look at somebody's credit report and say, well, 3 months ago, they were maxed out, but they have systematically brought that balance down, right? And you can see their scores increase as a result of that.
One thing that's included in your credit report is a credit score. Talk about that. What is a credit score?
So a credit score is the numerical, I guess I would say it is the numerical definition of your credit report or your history, if that makes sense. it is a little bit tricky in that there are different types of credit scores, right? So there are scores that weight your revolving credit differently and your installment debt differently. Installment debt might be like a vehicle loan. Revolving debt might just be like a credit card, right? Like a Visa or MasterCard. And depending on the product that you are shopping for as a consumer, the bank or creditor may look at a different scoring algorithm or methodology. So a lot of times I get questions and folks will call and say, I looked at my credit on, I don't know, freecreditreport.com, or Credit Karma is a real popular one, right? And it says my score is 800. And then I may go in and run a credit report for your new home, and it might be a 760, right? And that's because there are different scoring algorithms and methodologies, but they should overall be within a range of one another, if that makes sense.
Is a credit score the same thing as a FICO score?
So credit score that would be one of the credit scores. So the three major credit bureaus are TransUnion, Equifax, and Experian. Experian also is known as FICO. Experian generates your FICO score, essentially, and which is, I think, historically probably the most popular and most well-known score out there. When people kind of talk about credit, they say my FICO. It's kind of like when you order a Coke, but it's a Sprite. It's very similar in that regard. Now, for a mortgage, the industry practice is that we pull all three credit scores. So your Experian or your FICO score, your Equifax score, and your TransUnion score. And what we do for a mortgage, other creditors do things differently, but our standard in the mortgage industry is we take the middle score. We don't average them. We just take the one that's slap in the middle. And if there are two borrowers on a loan, let's say, a borrower and a co-borrower, a spouse and spouse, et cetera, we'll take the lower of the two middle scores, and that's what's used for interest rate pricing purposes. If you're purchasing a car, it's industry standard generally that they tend to just look at your FICO score. They tend to just pull one score, and that's what they go with, and that's just how that industry, that's what their standards are, generally speaking.
Okay, so you touched on this very briefly, but I want you to talk about it perhaps a little bit more in depth. Who are considered the major credit reporting agencies? Let's touch on that one more time.
Sure. So your major agencies are TransUnion, Equifax, and Experian. They each have their own methodologies and scoring on how they weight different types of debt and pay history and things like that. And so when you're going for a mortgage, as I mentioned, we pull all three credit bureaus, all three credit scores. Now, some people don't have three credit scores. Most people do, but some people, they may have a very limited amount of credit in their name, right? Maybe one or two cards, maybe a vehicle. And so it's up to each creditor to determine which credit bureau or which credit agency they want to report to. It is usual and customary generally that most creditors, whether it be credit cards or student loans, they tend to report to all three of those major credit reporting agencies. And I think that's probably why, from the mortgage perspective, the bank pulls all three to make sure that we're getting a good cross-section of what the history has been. Because there may be situations where this happens often. Sometimes we all know how tricky medical bills can be, right? I mean, they tend to bite you, and they're on your credit report, and you may not even know. Generally speaking, a lot of these medical collection companies tend to report to only one or two agencies. They tend to not report to all three because it costs them money to do so on a monthly basis. So they may choose one agency to report to, And so that's why, from a mortgage perspective, generally we pull all 3 credit bureaus so that we can have a good cross-section of our applicants' history and where they are currently. Because your credit report really, it's very important, but it is at the same time also a snapshot in time. It's not necessarily, it gives a story, it tells a story, but it is at the end of the day a snapshot in time of your current standing, and which can be changed over time, of course.
How is that credit score calculated?
Good question. So there are, as I mentioned, a number of different algorithms, right? Almost, I don't want to say black box, but almost different algorithms that are calculated for this. But the factors that go into that calculation are going to be the length of the time you've had accounts open, the longer you've had accounts open, specifically with regard to credit card accounts, revolving credit card accounts. That helps your score. Your pay history, of course, are you paying on time? Are you paying early? Are you, there's a term called slow pay, where you're kind of just, you're paying on time, but it's almost to the due date. That gets calculated in there. The amount of usage on your revolving debt relative to the limit, right? If you are using generally above 30% tends to be where the credit bureaus tend to begin to ding your score. The reason I think that is in place is because the credit bureaus want to know that if there's a financial emergency, you have some wherewithal through your credit to handle that emergency, right? You're not going to be completely maxed out to a point where you may be deemed a credit risk and a default risk on paying those cards. So generally, a rule of thumb, you want to keep your revolving debt balances 30% or lower. So that goes in there. And then also just the credit limits go in there as well. And then your pay history are the main things that determine your credit standing and your score. When you have a mortgage, that is a large driver of your credit score. If you don't have a mortgage, your largest driver tends to be the revolving debt, the credit cards that you have on a monthly basis.
You said something that I didn't know, that if I pay a debt or a bill on time, but close to the due date, that could in fact ding my credit score.
It could, yeah. So that's what we call slow pay. And so what the credit bureaus look at the pay history and how often you pay and when you pay. And that's important. So you always want to try to, so most credit accounts, right, you've got a 15-day grace period, right? We'll say it's due on the 1st, late after the 15th. You get charged a late fee after the 15th. It is not generally reported to the credit agency as a late payment until you're 30 days late, right? The credit bureaus will really ding your score 30 days late. But a slow pay could prevent your scores from, it could have a suffocating effect on your score, if that makes sense, where it doesn't allow your credit to breathe and grow and increase properly.
We have a question from someone in the audience. I guess it's kind of a philosophical question, but I'm going to pose it anyway. This person wants to know, so what is the point of a due date if you get dinged for paying early or on time?
Well, you don't necessarily get dinged for paying early or on time. It's more so if you have a history of, paying shortly after the due date, but not that full 30-day late period, they just take record of that, right? And they take record of when your payments come in. And also that could also affect, let's say, for example, you have a credit card, we'll say, right? And you would like to apply for a line or credit increase, right? That is something that credit card companies, they may look at that and determine, well, its payment's a little slow. We're not sure if we feel like trusting that individual with a much larger line of credit, right? Those are things that those companies look at when determining, you know, what your capacity might be for a line increase. But I think to answer your question specifically, of course, they kind of have to draw a line in the sand somewhere, and I think that's where they choose to do it. And specifically for mortgage, which is installment debt, you know, your payments are always due on the 1st, late after the 15th. The misconception is that when we say late, that means that it's going to hit your credit. That's not necessarily true. Well, it's not true that it can only hit your credit if you're a full 30 days late. But if you pay on, we'll say, day 16, you would be charged a late fee that generally is calculated as a percentage of your mortgage payment, and that gets added on to your next monthly payment or what you're getting ready to pay. I hope that helps.
I always try to pay a little extra principal on my mortgage. Does that help my credit score?
It not necessarily. Well, it could over time, right? Because it would affect, or would, you know, affect your loan to value. But your loan to value on your home generally is not really reported on your. It's not a function of your credit. So it helps, of course, your equity position and the amount of interest that you pay on a monthly basis, and amortizing that mortgage sooner. So it will help your overall financial life, but that doesn't necessarily, over time it would, because you'd be paying it off early, right? And you're taking a 15, 20, 30-year debt that you may have on your mortgage, and hyper amortizing that, paying that down early, and that's important.
Things do happen in life. Sometimes, as you pointed out, there are medical expenses, unexpected expenses. We might miss a payment. We might be late with a payment. There is some life event that caused us to be late or miss a payment. How long does that stay on our credit report?
So in general, a late payment or any type of, so a late payment generally is about 7 years. It falls off. Bankruptcy, any type of what we would call a credit event. This would be something like a bankruptcy, a foreclosure, maybe a deed in lieu of foreclosure, a short sale, or even a mortgage deferment, or what we would call workout, if that makes sense. Those tend to stay on for about 10 years, and then they fall off. So now there are some bills working through Congress as it pertains to medical collections and how they're able to report, and how they're able and how long they're able to stay on, and some parameters around that would reduce some of those time periods, and in some cases even not even allow some of that stuff to report. That's working its way through. Of course, nothing has been passed or agreed upon, but I think that is a concern that everybody has, right? I mean, I know for me personally, you know, I had a baby boy last year. My wife and I had a baby boy last year. We had a lot of complications, a lot of medical bills. Stuff just popped up, right? And fortunately, we were able to catch it before it got to the credit bureaus. But the medical stuff is a tricky thing, and it is different than if you miss a payment on a visa, right? They tend to kind of show up, and the insurance is tricky. All that stuff can be tricky. So I hope that, you know, 7 years for kind of missed payments, mortgage stuff, credit cards, vehicles. If you've got any credit events like a foreclosure, a bankruptcy, a short sale, even a repo on a car, repossession on a car, that's going to stay on for up to 10 years.
I was on a flight recently, and on that flight, the flight attendants came by offering credit cards applications with tons of perks apparently. Does simply applying for credit affect your credit score? Let's say I'm shopping for a car and I go to several dealers and each dealer runs a credit check, or I were to simply apply for that credit card. Does the act of simply applying for credit or having your credit checked, does that impact your credit score?
It can. I say that with a little bit of a caveat. So it can slightly, ever so slightly. However, let's take an example where you're shopping for a mortgage, right? And let's say you call David at SouthState here in Charlotte, and you call Jim at Wells Fargo and Bob at Bank of America, right? And you have your credit run for a mortgage, the same line of credit, if you will, the same type of credit, right, for a mortgage. The credit bureaus will effectively count that as one credit pull, because the credit bureaus know you're being a consumer and you're going to shop around and do what a good consumer should do, right, and look at different options, different rates, different things. Now, where it becomes a challenge, and they give you about a 2 to 3 week window to do that, right? Where it becomes a challenge is if you come to Dave, get a mortgage, run a credit for a mortgage, then you go buy a car, then you go buy furniture, then you go buy appliances, right? You're running credit through different veins of different credit. The credit bureaus then take notice of that and they say, oh, well, you're now a much higher credit risk. And maybe you're not as liquid as you should be for all these things. So at that point, they will then, really ding your credit. So I hope that scenario helps, but as long as you're kind of shopping in the same vein, for whether it be a mortgage or even a car, I would say be careful sometimes with dealers, car dealers, because while they're trying to get you, of course, the best rate, no question about it, they do shop your stuff to a lot of banks. And each bank will run their own report, and that can result in a decline in the score.
We have another question from someone who's in the audience. Is it bad for your credit score to pay your credit card off multiple times a month? For example, if I spend $250 at the grocery store and then pay it off when it hits my statement versus waiting until the due date. Does that understand that question?
Yeah, so I would say that's a two-part answer. I would say if you are in really good credit standing, right? Your scores are up there, then I would say no, it would not negatively impact your credit. I would say if you have room to grow on your credit, it may benefit you to pay down most of it and then let a small balance report on a monthly basis to the credit bureau and then pay that off, so that the agencies can see that you can manage a small balance on a month-to-month basis, and that'll help your credit score move up. So that way you're showing pay history, management, and good standing.
I've heard that before, that actually paying off your balance every month may not be as good for your credit score as carrying a little balance. That seems counterintuitive.
Yeah, it does, right? A lot of credit can be counterintuitive. For example, if you said, I'm going to pay off this credit card, I hate this Macy's card at 15% interest, whatever it may be, right? I'm going to pay it off and I'm going to close it. Well, that could negatively impact your credit score. There's something called a debt to available credit ratio, right? So the more accounts you have open at a zero balance, you have a higher available credit across your spectrum of debt, or of your accounts rather. So it would be better to pay that card off and just leave it open and let it sit there at a zero balance and not use it, unless you were in Macy's and wanted 10% off. But to answer your question specifically, Glenn, yes, that is counterintuitive, but it for a period of time, for some people that maybe are looking to increase their scores, whereas maybe in the past they didn't have a great history of pay or management on those credit cards, it could benefit them to leave a small balance, go to dinner, buy some gas, whatever the case may be, pay it down a little bit over time so that you can demonstrate to the credit agencies that the ship has turned, you're making progress, you're managing your payments, you're managing your what we call debt utilization, the amount, the 30% that we talked about, to show good pay history and begin to rebuild that. And that could be something that will help your scores increase.
What are the different types of credit? I know there's installment, or what are the different types?
Yep. So we'll start there. The installment debt is a type of debt that is repaid in defined, generally monthly installments, right? These are items like student loans, vehicles, mortgages. There are personal loans that are installment loans, unsecured loans. So let's backtrack. So there are two essential types of debt, right? There's secured debt and unsecured debt. Secured debt is where there is collateral for that debt. That would be like a vehicle, a mortgage, a house is the collateral, right, for that debt. Then there's unsecured debt. That would be credit cards, student loans, any kind of personal loans that you have out there, that kind of thing. Within that umbrella, there are then installment debt. There's revolving debt. Revolving debt is, credit cards or a home equity line of credit. That would be a revolving debt, where it's just kind of you have a credit limit, you can use it, pay it back, use it, pay it back, so on and so forth. And those are the two main types of debt that you have.
There's something called the debt to income ratio. Can you talk about that just a little? And does that imply that the credit reporting agencies know how much my income is?
They have an idea. They have an idea of how much your income is. Your debt to income ratio is how much monthly debt service you have, right? What are your monthly payments compared to your gross income? Gross income being before tax, right? And so banks look at that to make sure that what factors into your debt ratio is all the minimum monthly payments you have on credit cards, student loans, any other mortgages you may have, or vehicles, any other monthly debt that's reporting on the credit bureau. And then we add your new mortgage payment, property taxes, and insurance to that to arrive at your debt to income ratio. General rule of thumb, the bank wants to see, and some products go higher in this percentage, but generally, 43 to 45% is where we want to see your debt to income ratio from a mortgage perspective. We want to make sure that all the monthly debts that you pay, including your mortgage, taxes, insurance, et cetera, property taxes and homeowners insurance, are equal to or less than 45% of your total gross income. And that way we know that there's sufficient cash flow for you to live the rest of your life. You got to pay some to Uncle Sam. They always take their chunk, right? So that's why you see 43. Now, some products like FHA or VA products, they can go higher. They can go 48, 50, 51%, depending on some other factors that may influence that credit decision. But that's what your debt to income ratio is, and that's how it's calculated.
So I want to go back to something you said earlier. You said earlier that carrying a little debt could help your credit score more than carrying no debt. Is there such a thing as having too low a debt to income ratio? If you have no credit cards, if you have no car loan, let's say you're pretty much living on a cash budget. Is there such a thing as having a debt to income ratio that's too low?
No, there's not. The low, if essentially the lower the better, right? To a degree. However, that is balanced with, one of the main components of a mortgage decision or any type of credit decision is the credit report and the credit score, right? And so we look at the income and we look at the debt of what you're applying for, and we put that into the debt to income ratio. But a component of the other component that goes into that piece is, well, what does the credit profile look like? What does the credit history look like? And so if you have no credit accounts, right, you may have no credit score. And it may not be that you have bad credit, it just means that you don't have credit. And that can be a challenge as well, because the bank is gonna look for, what does that history look like, right? Is there a history of on-time payment? It's really kind of the only way that we can verify based on our industry standards and what's required. So let's say an individual doesn't have much of a credit score, maybe they're young, maybe they're out of college and they don't have experience or history, or they're just starting out. Some people have this option, other people don't, but becoming an authorized user on, maybe mom or dad's credit card or whatever the case may be, that can instantly import a long history of credit and management, right? And that could immediately bring your scores, by piggybacking off of them, if you will, that gives you instant credit and an instant credit score.
We hear all the time that everyone should know what their credit scores are. They should get copies of their credit reports. One, why is that important? And two, how does one go about getting copies of his or her credit report?
So that is right. I mean, so you're allowed one free credit report per year from, I believe the website is freecreditreport.com. They'll give you the report. You generally have to pay extra for a score. However, I find that most credit card companies now have access to your credit score through their portal, through their app, whatever the case may be. So it is important though to review, your credit report at I would say at a minimum one time per year. Especially if you've had a busy financial year with either medical stuff or just you're moving money around, doing different things, buying, selling homes, whatever the case may be, cars. You want to just review that to make sure what's on there is accurate. And that's the biggest thing, because if there's something that you do need to go on and dispute, that can be, somewhat of a lengthy process. And then that of course could impact your ability to continue to move forward in your financial life, whether it be buy a car, or maybe you need you're going back to school and you need a student loan, whatever the case may be. So it's important to make sure that what's on there is accurate, so that that when you're ready to make any kind of financial move, that's not something that's going to creep up and bite you.
So just to repeat, that website is it freecreditreport.com?
Let me get you the web. I don't want to tell you the wrong website. Let me get back to you with the exact website, but I believe it is freecreditreport.com. that you're able to get one free credit report per year from the credit bureaus. And it is something that they can mail you, or I believe you can download it directly. But I will circle back with you and get you the exact web address so you can get that out to your audience. Okay.
One last question, David. I'm thinking about buying a house. I'm thinking about buying a car. Am I able to go to SouthState Bank and talk with someone like you in advance? Is that advisable? What should be my first step if I'm thinking about making some major purchase that might require credit?
Yes, I mean, you always want to start with the money first, right? That is always where you want to start. So whether it be, let's say, a home, come into SouthState. We have tons of branches around the city. My branch is in the South Park location on Morrison Boulevard. That's where my office is. I'd be happy to sit down and meet with anybody, or even something over the phone. We're all busy these days, but you want to start with the money to understand what your capacity is. And I think what's even more important with that is you want to find out what you're comfortable with. A lot of people on paper will qualify for more than what they feel comfortable with on a monthly basis per se. And so you want to make sure that you know what products are available to you, how that fits into your overarching financial goal, and the same with the vehicle. I know for me, when I go car shopping, I start and I get my pre-approval from a local bank first, so that it gives me more leverage when I'm on the lot with the dealer. And I say, hey, listen, my financing is already taken care of. I just need to talk to you about the price of the car. That's it. And then you're not kind of in the finance office and they're wheeling and dealing in there. So the other piece of why you want to start, especially with a home in today's competitive market, you want to start with the money so that you don't find something on, we'll say, Zillow that you fall in love with, and then you come to the bank and the numbers aren't what you're comfortable with. That's not a good feeling. So you want to know and be confident with what your borrowing capacity is and where you feel comfortable. Because when you own a home, it's not just a home, right? The mortgage payment then just becomes one component. There are any number of other things that pop up as a homeowner that you need to be prepared to handle. It's on you. So, always start with the bank, get your pre-approval, even if it's just some basic questions. And we have to walk through some ways to figure out how to improve the credit score or maneuver that way. That's why you want to start with the banker.
Okay, well, thank you so much. That was David Havlik, mortgage banker at SouthState Bank. Thank you, David, for joining us today. And thank you, SouthState, for sponsoring this edition of Expertalk. I'm Glenn Berkins, editor and publisher of QCity Metro. Until next time, have a good day.
Thank you, Len. Thank you, everybody. Have a good day.